Over the past week, you may have noticed or you may have gotten a message from your bank informing you of new rates for existing or new loan facilities. This was occasioned by the central bank, which last week announced a 2% increase in the base lending rate. The base lending rate, or the CBR, the central bank rate, is the rate at which banks borrow from the central bank. In their normal operations, banks often take short-term loans from the Central Bank of Kenya, which allows them to be liquid, like you can withdraw some of the money you have kept in the bank even when that money is invested elsewhere, and you can also borrow as an individual, as a business. The CBR, or the base lending rate, is also a tool that the central bank uses to manage the economy. This is done by central banks around the world. They use it to strengthen the local currency, they use it to control inflation, they use it to spur economic growth, etc. So why did the Central Bank of Kenya increase the CBR? According to the CBK, the increase in the CBR was intentioned to strengthen the Kenyan shilling. The shilling's continued weakening has had a negative effect on the economy, including increased costs for imports, cars, the cost of fuel has gone up, and it has affected many other things that are dependent, like electricity, like transport, and all other sectors of the economy. And this increased inflation has contributed greatly to the high cost of living. So the CBK hopes that by increasing the central bank rate, the pressure on the shilling will ease, and this will happen because investors will be more encouraged to put the investments in shilling denominated assets. You may have heard of people saying they are keeping their savings in the form of dollars. You have heard of companies keeping their operating expenses in the form of dollars instead of the shilling, even when they are based in Kenya. So these dollar shortages have continued to weaken the shilling, and as a ripple effect, we are spending more Kenya shillings to get imports, and the cost of living continues to balloon, and then there is a circle of the shilling weakening further. If the central bank's hypothesis works, it means that people will be more encouraged to hold their investments in the Kenya shilling, and the shilling will start to strengthen, and as the pressure on the shilling eases, it will gain against the dollar, and now we'll be spending less to buy the same amount of fuel or to buy the same car, because the shilling will be stronger against the dollar. Ultimately, this will ease inflation and reduce the cost of living. While banks do not have control over the actions of their regulator, the Central Bank of Kenya, you may have noticed that individual banks are working in their own internal policies to cushion Kenyans against the effects of the higher interest rates, including you may have noticed there is the risk-based lending model, which allows more Kenyans who may not have qualified for formal banking facilities to access them on customized lending rates. Number two is responsible lending, where banks are taking their time to ensure that the loans extended to customers are repayable. There's also a lot more financial education on budgeting, for example, on investment tools that people can take advantage of. You may have heard, especially during the past 1 year when things have been difficult, banks have worked on that. Money254.co.ke has written more in detail about the central bank's CBR and its impact on the economy. Click on the link provided to learn more.